By the results, I mean, we did see sales come in pretty much where we wanted. I think about the $8 billion mark, yet earnings were slightly lower. Were you surprised by anything that we saw from Tom's points just now?
Yeah, no, look, I think the market's more focused. I think, like, these companies are now sort of putting enough guidance out that they're always going to come in pretty close. I think what people are looking at now is the cost. So, as James touched on, about the rising costs here, cost of Aussie dollar, the wage costs here. I mean, anecdotally, a lot of the young men getting paid big money out of uni to go and, in engineering jobs in these sort of firms here. So I was hearing last week that there was 10,000 mining jobs on Ymyc at the moment. So it tells you that there's a big demand there. They're paying big money for these people. So that's a bit of an issue there. I would love to sort of ask Tom a question there in terms of commodities, because if you've got this sort of global issue here in terms of the debt in Europe and also in the US there, this could have an influence on commodity prices, because obviously when the GFC, their commodity prices tumbled pretty hard in that period. So I think the commodity prices are at risk here, and that's going to have a bearing on the business. So if you've got rising costs, commodity prices coming down, then that's going to squeeze margins. So I think at the moment the market's focused on the costs, which are going up, which are squeezing the margins of the business. But if you get commodities prices coming down as well, then I think it's going to be a double whammy.
Sure, and that could definitely squeeze the company. I mean, the other side of things we do have to look at, of course, is demand out of China as well, and obviously that's waning slightly, and I think that's going to provide another, I guess, or the biggest area where we can see the potential impact is if we do see those inflationary pressures out of China, if we do see a slowdown in terms of demand out of China. I think these companies will be left with a whole lot of supply, and we'll probably start to see stockpiles as well, which we did see around the GFC. So a number of, I guess, very large factors still weighing out of Rio's control, really, when we're looking at the global economy. And the likes of Rio, BHP, I think, out of any stocks here in Australia, are probably the best to cope with any of those situations as well. They're very well diversified. They've got the best management in the business as well, and they've proven themselves for quite some time. In terms of BHP and Rio Tinto, what do you prefer? What do you prefer there, Gary?
Look, I'm short both stocks, so yeah, I actually think they're trading a lot lower. I've advised my clients for the last few months not to be in that space. I think this is a big macro shift out of that sector, so I'm short here in the short term, but really the longer term here, the next 12 months, I think it's going to be a tough environment for mining.
Yeah.
So even if BHP got to $36, which I think where it's going in the short term, I might play it for a bounce, but I don't want to be there long term, because I don't believe the story longer term. I think there's a lot more pressures, headwinds to go here. So I would be hard time, really suggesting to go that sector at the moment. So
sure. And
yeah.
David, you're out of